Well, guys, as if the stock market wasn't volatile enough, and as if it didn't have enough things to worry about with that whole thing that's going around the world that keeps spreading, that we can't directly mention here on YouTube, but we know that it's out there causing a lot of fear and panic, and countries are trying to deal with it. It's weighing on economies, it's weighing on businesses. It could potentially send us into recession. As if that wasn't big enough, a big enough thing to worry about. Now we've got an oil price war going on between two of the largest producers in the world. And by the way, I'm just going to refer to them as Rush and Sabia to be on the safe side because to be honest with you guys, I'm getting pretty sick and tired of working for YouTube for free. So I'm going to be careful with the words I say until things kind of calm down here. But anyway, those two things kind of coupled together sent the stock market essentially crashing yesterday on Monday. So the Dow Jones had its worst drop in history in terms of a point drop, and it was almost in bear market territory. It fell by over 19% from the previous highs during the time span. And if it would have been 20%, that would have been bear market territory. It would have actually ended our 11-year bull market, which is pretty crazy to think about. Now, I was looking at the futures for Tuesday because I'm recording this very early Tuesday morning, like hours before the market opens. I actually pulled an all-nighter to try to get this video out to you guys because I'm going to be out of town the next couple of days, so I wanted to get a video out to you because a lot of you were asking me for my opinion on everything that's going on. But anyway, I was looking at the futures and they're green, and so we could see a little bit of a rally here on Tuesday. So the market is just super volatile, but we could see a little bit of a rally if it kind of holds up. Now, in my opinion, I'm still kind of sticking with my original opinion that over the long term, this whole kind of horrible time period that we're going through will have ultimately been a buying opportunity. But for right now, things are looking pretty bad. And in my opinion, the risk of a recession has definitely gone up by a lot. So in today's video, I just want to explain everything that's going on, the whole oil price war situation, how that's affecting the economy, how that can lead us into recession, how that kind of raises all of the risk and all that kind of stuff, and give my opinion on everything as we go through it. And then I want to also let you know what I kind of plan to do as well. So should be a fun video. I hope you guys enjoy it, but let's just go ahead and start by taking a look at this whole oil situation, and then we'll just kind of progress from there. And by the way, we will also take a look at those futures and take a look at why they're green, but we'll do that more towards the end of the video. Okay, so basically oil prices crashed by more than 30% in overnight trading into Monday. Now, those prices did bounce back a bit off of the lows, but they're still down huge at this point. And while nobody really saw this coming, a lot of it can actually be traced back to last week when Russia refused to cut the production of their oil, which OPEC members were trying to reduce by an additional 1.5 million barrels a day to try to stabilize supply and demand, as oil prices have already been falling for a long time now and have only gotten worse ever since that situation that we can't really talk about has lowered demand for oil even further, since people are not likely to be traveling right now, which has also led to flights and cruises being canceled and thus sent their respective stocks crashing. But why did Russia refuse to cut oil production in the first place if it would have obviously helped with the supply glut and in turn help stabilize prices, which ultimately does help all parties involved? Well, they argue that even though they keep cutting production, the United States keeps increasing it, and that's been hurting the economy of Russia and making them less competitive. And I'm not agreeing or disagreeing with them, I'm just telling you what they're saying, and that's basically that enough is enough, and they're not going to cut anymore because they keep getting the short end of the stick. Well, as a result of that refusal to cut production, Sabia, which happens to be the second largest producer in the world, just in front of Russia and just behind the United States, although I think they might be the biggest exporter of oil and also the biggest member of OPEC, but they essentially decided to retaliate against Russia for not agreeing to the cuts. And because those two countries are some of the largest producers of oil in the world, a price war between them can be extremely serious for the global economy as well as the United States economy as well. Now, Sabia decided to not only lower their official oil prices, but they also plan to ramp up their production from 9.7 million barrels per day to as much as 12.5 million barrels per day. So add it all up and you've got falling demand for oil, falling prices for oil, and to make everything worse, you also get rising production and supply. Obviously, that is disastrous news for oil companies because it will ultimately mean lower sales and profitability for them. As a result, oil stocks crashed huge on Monday, with ExxonMobil falling by over 12% and is currently down over 40% year to date. Royal Dutch Shell dropped by over 17% on Monday and they are down over 21% year to date. And much more pure plays like Occidental Petroleum got absolutely crushed, with Oxy getting devastated. They crashed by over 51% just on Monday alone and are currently down almost 70% year to date. By the way, a lot of my viewers always ask me for my opinion on oil stocks and if I'm ever buying any, because they have been, crashing a lot and they usually pay some very high dividend yields. But I have a few different thoughts on that. Now, number one, I'm not a big fan of oil stocks because I don't know a lot about them. I'm not very well experienced with the industry, so I generally avoid them. But I'm also not a fan of how vulnerable they are to what big governments are doing. And I also don't like how cyclical they are. As more of a long-term investor, I don't like to have to predict what's going to happen kind of short and medium term. I like to just kind of invest long-term and not worry about all that kind of noise. And that brings me to reason number two, which is that over the long term and into the distant future, I just think there's going to be more growth to be had in areas like renewables when looking at the energy sector. And that's just my opinion. I know opinions differ greatly on that. I'm not looking to start a fight. I just think that there's going to be a little more growth in things like renewables. So that's where I would rather make a play if I was going to invest in like the energy sector. And then finally, reason number three is that while I do think that a lot of the big players will be able to make adjustments and stay afloat, I think a lot of the smaller players are at risk of going bankrupt. And at the very least, I think balance sheets may deteriorate. And I think a lot of dividends can definitely get cut just kind of across the board. So there's a lot of uncertainties there and a lot of risks, but that is just my opinion. Anyway, all of this sent oil stocks crashing. And the reason why all of this is bad for the economy is because if a lot of these companies go out of business, then we could see a lot of employees obviously lose their jobs. And the other issue is that a lot of these oil companies are highly leveraged, meaning that they have a lot of debt. And if they go bankrupt, then what happens to the lenders that let them borrow all of that money? So think of like big banks, which by the way are already like expected to underperform because of the Fed lowering interest rates. But now you also have this whole oil issue to also worry about. And speaking of rate cuts, because of everything that's going on, some markets are now pricing in more than a 73% chance that the Fed will cut rates by 100 basis points at the March 18 meeting, which could potentially bring rates down to zero. And this is coming off of an already emergency rate cut last week. Now, on one hand, that may help consumers and businesses with borrowing money and mortgages and things like that, but it also hurts savers. And of course, it's not great for banks either that also have the whole oil issue to worry about as well. And so as a result, some of the most popular bank stocks crashed on Monday too, with Bank of America dropping by over 15% and is now down almost 40% year to date. Wells Fargo dropping over 12% and is also down almost 40% year to date. And even the only bank stock that I own myself in JP Morgan Chase dropped by over 13% and is currently down over 33% year to date as well. But with all of this uncertainty going on, I wouldn't be surprised if there's much more room to fall, especially if we go into a recession. Now, having said that, I was doing some research on which bank stocks have the most exposure to energy, hoping that JPM would be low on the list, and actually found this chart from Morgan Stanley that shows energy as a percentage of loans last quarter, and JPM was less than 2%. So I am happy about that. It does seem, pretty low to me. Although again, I still think that there's a lot of risk here depending on how everything plays out. Now, in terms of what kind of solutions we'll have for this whole oil price war specifically, and again, I'm not an expert in this area, so you really shouldn't look to me for this, but from what I read from the so-called experts, a few of them said that the solution to low oil prices is actually low oil prices. And my interpretation of that is that I don't think it really benefits anyone to have these low oil prices. Now, I guess it could benefit the consumer or maybe some businesses that use a lot of oil because it could lower their operational costs. But in terms of the pure players like the producers and sellers of oil, it doesn't really benefit them to have those low prices. So if things continue to get a lot worse, then that could lead to some diplomacy and maybe both sides come back to the table and negotiate and maybe we can stabilize oil prices. And coming off of the backdrop of a lot of like fiscal stimulus and policy to kind of deal with that other global issue that keeps spreading around the world, and if that also gets under control, then all of this could lead to one heck of a rally coming out of it. But the problem is that we still have a ton of uncertainty because until any of these things happen, we really have no idea how everything is going to play out. So I think there's still a lot of risk to the downside and the risk of a possible recession as well until we get more clarity. And until that happens, the stock market is going to remain very volatile and take some big hits. And that's exactly what happened on Monday. In fact, the Dow Jones dropped by over 2,000 points on Monday, which is literally the largest point drop in history of the stock market. And even if we look at the percentage drop, it still ranks as the 11th largest of all time, which is pretty crazy. On top of that, when looking at the VIX, which is the stock market's fear gauge that basically rises when there's a ton of fear in the market, and it basically hit record highs during the financial crisis, it rose on Monday to levels that we haven't seen since the financial crisis, obviously signaling that there's a gigantic amount of fear and panic in the markets right now. Meanwhile, Trump's economic team is expected to meet to discuss potential measures to stabilize the economy, which we will talk about in just a second when we take a look at the futures. But with things being so out of control right now with fear and panic, investors have fled over to bonds, which raised the price of them and in turn lowered the yield of the 10-year treasury to a new all-time record low, which I think is crazy because the dividend yield on just the S&P 500 has now climbed to be way higher than the 10 years. So stocks are looking much more attractive than bonds, especially those safe ones that have good yields and long track records of growing them even through recessions. For example, just a couple of the ones that I own myself include stocks like AT&T that pays over a 5.6% yield, although my yield is technically 7%, but they've increased that dividend for 35 years in a row. And then there's also 3M, which admittedly I just now started nibbling a tiny position of, so it's less than 1% of my portfolio, but they pay close to a 4% yield and have also increased it for a massive 61 years in a row. But even a bunch of stocks that I don't own have some very attractive dividends when compared to bonds. Something like Johnson & Johnson, which is a pretty solid consumer staple and pharmaceutical stock, they increased their dividend for almost 60 years in a row. And then there's others like Coca-Cola for 57 years and almost a 3% yield. There's PepsiCo, which is also pretty similar, and that's a stock that I've always wanted to own. And even though I'm not a fan of oil stocks, there's even some energy ones that I like in renewables, like Next Era Energy, paying over 2% on 25 years of growth. And that's another stock that I've been wanting to buy for a long time. Shoot, even Microsoft is also starting to look attractive again with a small but high growth dividend, and they've now fallen by over 20% from their highs. And Microsoft is already my number one largest stock, but if it keeps falling or we go into a recession or anything like that, I definitely would be interested in picking up more shares. And I think that's really where I'm going to start paying more attention and looking for good deals, is very high quality companies and stocks that don't normally go on sale and are not necessarily doing anything wrong themselves, but if the overall market drags them down, then those could start to get very attractive. And so stocks like Microsoft, stocks like maybe Amazon, maybe some Google, which I don't own Google. Amazon, my second largest stock. Google, I don't own, but maybe some Nvidia. That's like pretty good growth stock. Maybe some Facebook, always pretty good value stock. Definitely some Visa. Visa is a stock that I've already started to buy, and that one rarely goes on sale. And the more that one gets dragged down, the more attractive it becomes to me. And then of course, a lot of dividend stocks become more attractive the more they fall. So big players like maybe Next Era, that's a stock I would love to pick up. Maybe some PepsiCo. I already have some AbbVie. Maybe I would add a little bit to that. Maybe I would add a little bit to my AT&T. Another one, maybe Caterpillar, although Caterpillar I think has a lot of risk. They could potentially fall a lot more, but that's another one that I would also kind of think about. And then of course, there's also the travel stocks. And I know in my last video, I mentioned that I was starting to nibble away at some Delta and some Carnival. And by the way, those are less than 1% of my portfolio. And people always get kind of like surprised when I say that because they say, oh, only 1%? Why is it only one? But the thing is, guys, like I'm a long-term investor and I like to do my buying when stocks are going down. So I can't just go into a stock when it's a brand new position. I can't just go into a stock like that and pick up like 10% of my portfolio in that stock because I always have the expectation that the stock is going to keep falling. I don't try to time the bottom, so I usually enter stocks kind of early when they're starting to fall. And if I'm going to be doing that, then I have to be very careful to buy the stock very slowly and in small amounts so that I have a lot of room to add to it as it falls more and get my cost basis down a lot. So that's why stocks like, Delta, Carnival, and also 3M that are all new positions for me, they're all less than 1% because I just recently kind of nibbled away at them. Now, having said that, I still like them long term, and I like Delta probably more, for sure more than Carnival, because it's an airline company. I feel like people still need to take flights, and when all of this stuff kind of gets settled, I think that it'll be faster to recover on the upside too. But when looking at something like Carnival, that one I'm a little more on the fence on, and I've kind of taken a step back and I'm kind of thinking about it more if I really want to be buying it, because I just really can't imagine anybody wanting to take a cruise right now. And I know that the State Department was like telling United States citizens and residents to not go on cruises. So I just really feel like they're going to have a very, very hard 2020. And I know that the stock has been beaten down a lot already. I know that they have a very high dividend, but that dividend got cut, I think, during the last recession. So I could see them wanting to cut the dividend right now as well. And the issue too is that they've got their own kind of specific issues with travel stocks because they're going through this whole kind of issue. If we end up going through a macro recession, that's like a double whammy to kind of hit them even harder. So there's a lot of risk there. Having said that, I still believe in them long term, so maybe I'll kind of nibble away at them a little more, but I am kind of taking a little bit of a step back, and I'm trying to focus a little more now on those higher quality companies like, the Amazon and the Visa, and maybe some dividend stocks, maybe some PepsiCo, maybe some AT&T, AbbVie, things like that. So I'm just looking for a little bit higher quality, lower risk at the moment, because like the risk of recession and other issues are kind of rising in my opinion. Okay, now it's not all bad news. We've got futures to look forward to, I guess. So at the time of this recording, or at the time of this screenshot, we did have some futures here. So let's take a look at this. This was at around 3:30 in the morning Eastern time. The Dow Jones Futures are up by over 600 points, which is a decent little uptrend there. We'll see if it holds. But as far as the reasons why, it's looking like Trump is vowing to give major economic support to help stabilize the economy, noting that there will potentially be a payroll tax cut, paid sick leave for those who need it, and ongoing conversations with hard-hit industries like airlines, hotels, and I'm pretty sure cruise lines are included too. But apparently he will also offer a loan program for small businesses that need additional help. And finally, he said that he will talk more about these policies later today, and they will be major policies to help with everything that's going on. Well, I hope that it helps. We'll have to wait and see what happens. I know that a lot of people are saying that you can't really solve that global issue with fiscal policy like this, but in my opinion, look, if it helps some of these companies that are going to be struggling, if it kind of helps them stay afloat or kind of get through this, then I don't necessarily have a problem with it. But we'll see if it works or it doesn't. And we'll see if the futures hold. We'll see if we have a nice little recovery here on Tuesday. And we'll just kind of have to wait and see how everything plays out through the week and if we start to get more clarity or not, if things stabilize. Now, on the opposite side of that, I think we could go into recession. On the positive side, things could stabilize and we could have a major recovery rally. We'll have to kind of wait and see what happens. But as far as like what I'm doing, yeah, I might continue to kind of nibble away at some positions, but I'm focusing a little bit more now on higher quality stocks, and I'm kind of hoping that those get dragged down more so that I could pick up some of those at some great deals. But I'm being very cautious at the moment. I'm kind of taking a step back and just trying to strategize a little bit more and be very precise and careful with the decisions that I make. Anyway, let me know what you guys think down below. I think that's pretty much everything covered there. And if you have any questions, concerns, thoughts, leave them down below. And I wish you guys all the best of luck. Stay safe out there. Think smart, think long term, stay calm, and be patient. And yeah, I don't know what else to say, but we'll get through this. We'll all get through this. So anyway, thanks again for watching. I'll catch you guys in the next one. Take care. Bye-bye.